Welcome to Inside the Boardroom. We turn now to a Canadian mining company focusing on producing gold and copper. It's called New Gold and is currently operating two key mines, Rainy River in Ontario and New Afton in British Columbia. Its Q1 results beat expectations, buoyed by rising copper sales and the full acquisition of the New Afton mine. Well, joining us on Inside the Boardroom is New Gold President and CEO Patrick Godin to walk us through what's behind the numbers and where growth goes to next. Patrick, thanks very much for joining us.
Thank you for the invitation.
Well, a lot to talk about, but I just want to get, your feel. You've had a great run on the share price over the last few days. I think at one point reaching 19% of a surge. You must be a happy man.
Yes, we're happy. So it's the conclusion of multiple years of effort. And I think that we're really proud of that, yeah.
So let's talk about your Q1 results. Now, revenue was up there, although gold production output was low. What were the main drivers?
But on a corporate point of view, I think we achieved our guidance. So Rainy River had less production than expected. Leads you to some pushback sequence, but New Afton overperformed. So we are completing the extraction of the B3 block cave. When we are planning our reserve, we always plan for the worst and wish for the best. So, and what it was in B3, we slightly over recover as we have better grade and more tons than expected. So we push more tons in the mill because we're not that where capacity is not limited for now. So we produce more at New Afton and produce more cash flow at New Afton. And so basically we are mostly we achieve. We also refinance our debt. So we roll our high yield bond so now the down payment will be in 2032. So it preserves our liquidity. We extend our revolver facility. So, and we overtop it with an accordion of $100 million. So we have more liquidities available. And the thing that we did, and we are really proud of, is last year, at New Afton, we sold 46% of the asset to teachers in counterpart. So the 46% of the asset, or 42.5% of the free cash flow. It was there at their peak. And we bought back last year 22.6% of the free cash flow options. And we had 19.9 that was remaining. And we bought it back this year. But the way that we purchased that is without diluting. We did not dilute our shareholders. We did not raise equity. We did a prepay of $100 million, and we also use our cash on hand and revolver facility for the rest. And also it's really creative for shareholders. We're seeing a lot of upside and nice future for New Afton. We are investing massively in exploration this year and last year. So I think it was the combination of all this, both one after the others, that help us to create real value for our shareholders.
Yeah, and it's interesting you spoke about New Afton because it was my next question. The fact that now that you have full ownership, that really impacted on the cash flow, didn't it?
Yeah, it's 20% of the cash flow, so it's really significant. So yes, it's important for us, mainly if you look forward.
Yeah. Now, you've made some major balance sheet moves lately. And I think you've touched on it. What does it signal, those balance sheet moves, about your financial priorities?
But first, it's I think in the current environment, we want to keep our powder dry. So I strongly believe that we have two good assets. We sold before I joined the company because they were forced to do this. They sold the Blackwater, which is now Artemis. So we don't have any project in the pipeline other than our two operations. So we need to, if we want to grow at some stage, and we need to look at other possibilities. So the objective that we had, it was to be recognized as a miner of choice, start to generate cash flow, to have a strong balance sheet, and I think we have a strong team and based on that, what's next? Yeah. So we have organic growth, and we are pushing extremely hard on this. I think that we can extend the mine life or maintain the gold production for a certain period of time. But over and above, we're not farmers, we're miners. Wow. And we should, I'm seeing also opportunities in the market, and we want to preserve our liquidity to look at this. So I'm proud to be the CEO of a Canadian mining company. And I think that if we want to shape the future for our stakeholders, our employees, and our shareholders, we need to look at grow our business, but we're not interested to grow to be bigger. We want to grow to be better. And if we can add one or two projects or two operational assets to our current assets, I think after that is going to be the beginning of something else.
Let's talk about that, because you've set aside this $30 million exploration budget. How do you strategize around that?
So actually, it's 17 will be allocated to New Afton and 13 to Rainy River. So Rainy River we are looking actually to we have an open pit mine life up to the end of 27. And we have motivated and qualified people. We have all the infrastructures in place. So, and Rainy River, they did not invest a lot in the past on exploration. The main objective was to make it work and make it happen. So now that we are in a different position, we start to investigate open pit expansion. So it's what we did. We did phase 5 last time. So we're looking for an northwest trend actually that can be positive. And to push the low-grade stockpile in a timely manner to maintain the production at a good level above between 250 and 300,000 ounces of gold per year. It's what we wish for. We also having the possibility at Rainy River to expand underground. So because it's an underground mine that will last up to 2033, great jurisdiction, by the way. So it's easy to mine. We don't having any issues and rock mechanic issues and stuff. For New Afton, it's a bit different. In the end of 2023, we discover a new zone, is the key zone.
Right.
And the key zone is mostly the same mining horizon of C zone, but sometimes maybe lower, 250, 300 meters lower than C zone. So we developed a drift last year to position ourselves to test this anomaly. So we discovered that, so we're pretty happy. Now we reposition, but we are limited by the position. So we develop a new drift. We developed a 700-meter drift this year. We are completed at 70% close by. And we'll have a drill that is functional, actually, and we'll add 4 drills before the end of the quarter.
Yeah. Oh.
And so with the objective to have indicated resources for year-end to do a feasibility study. And we're looking at a cave that can be similar to C-Zone.
I want to talk about copper, because you've got quite an impressive outlook for copper up until 2027 in terms of production.
Yeah.
Why are you confident that you'll meet those targets that you set?
But it's a block cave, so it's our block cave number 4. So I think that New Afton in Canada, actually, we're mostly the only mine who is using this mining method. So we're doing that since 2012.
Yep.
So we were pretty successful. We had all the lesson learned from the upper lift. We applied this to the C zone. So we reconcile our 3 block cave really well. So basically it means that the way that we forecast the dilution with the draw management is excellent. So the metallurgy is pretty easy compared to the upper lift. So basically we're really well positioned to deliver that. The grade is higher than the previous cave, the cave that we will complete the extraction at the end of Q2. So, and it's mostly 1% copper equivalent, so it's pretty good for an underground mine. So it's 25% of our revenue is coming from gold, 75% from copper. We're pretty versatile too. So what is interesting with New Afton is we can ship our concentrate that is high quality wherever we want in the world. So it's high quality concentrate, but we're shipping by sea and we're shipping by rail because we're close to the railroad. So basically, a big part of our concentrate is staying in Canada. It's going to the horn smelter in Rwanda. And the other part is going to Japan or to China. So what is the best option for us? So basically it's a mine that is pretty versatile. We're not seeing a lot of complexity other than the complexity of the block cave that we control.
Right, and I hear you. The controlling
because
issue.
It's pretty complex block caving.
I hear you. Listen, before you go, I want to get your sense. How are you balancing returns to shareholders versus, let's say, reinvestment and possible acquisitions? That balance is such a key one, isn't it?
Yeah. So our focus on the last 3 years was the value per share.
Yeah.
So that's what we look at because it was what we can control by our actions. At certain moment of time, it's the cash flow that will generate, because we expect to generate close to $2 billion of cash flow in the next 3 years. It's not my money, it's the shareholders' money. So if we're not having project where we can propose to them a return that is aligned with their expectations, at certain stage, it's their money. So, and we'll have to return this money. So for sure, and we have different way to do this. You've seen company who are doing share buyback is, on a tax point of view, is probably the best options for them. But in the end, and currently we still have money to invest. We'll be in better position for that in 2026. Basically because we draw a facility to buy back new Afton. So basically we need to refill the revolver. But basically, if we cannot work on project that will add value to them, we'll have to at certain stage return the money to them.
Yeah. No, that makes sense. It's been a pleasure speaking to you, Patrick Godin, CEO and President of New Gold. Thank you very much indeed for your time.
Thank you. Really appreciate it.
Indeed.
Thank you very much.